Why is it that when engaging with finance, some effortlessly achieve steady wealth growth while others stumble into cryptocurrency and various wealth management products? The answers to these questions were actually written in the annals of financial history thousands of years ago. From Sumerian clay tablet lending to today's mobile payments, an unchanging core logic lies behind it all. Today, we'll help you understand it and steer clear of those wallet-draining pitfalls. The core principles of financial history remain constant. Credit forms the bedrock of financial systems. Bubbles are the inevitable outcome of humanity's profit-seeking instinct. Finance acts as an accelerator for civilizational progress. These patterns persistently replay across emerging financial forms. Traces of this law can be traced back to the very origins of human financial activity. Around 2800 BC in Mesopotamia, the agricultural civilization of the Tigris-Euphrates region gave birth to the earliest financial needs. Though the Sumerians had yet to invent mature currency, they had already inscribed the earliest loan certificates onto clay tablets, with credit as their core underpinning. Archaeological discoveries reveal that these clay loan tablets were not isolated occurrences. Over 100,000 such tablets have been unearthed solely in core Sumerian city-states like Nippur and Uruk, serving as crucial evidence of contemporary socio-economic activity. A tablet unearthed at Uruk clearly records, Puzaram received 38 shekels of silver from Shamash, the sun god, to be repaid with interest at harvest time, at a rate of 20%. Such entries were exceedingly common among contemporary clay tablets. The clay tablet's efficacy as a credit medium stemmed from clay's local abundance and durability. The fertile alluvial plains of Mesopotamia provided ample clay resources. After simple sun-drying or firing, the tablets hardened sufficiently to endure for millennia. This physical property conferred an immutable quality upon them, offering a tangible foundation for trust between lenders and borrowers. Though lending activities were confined to familiar circles, clay tablets transcended the vagueness of verbal agreements, establishing an early credit constraint mechanism. This demonstrates that trust is the prerequisite for financial activity. Without it, no one would part with their resources, rendering finance impossible. This logic has been repeatedly validated throughout subsequent financial history. Bubbles, as the inevitable outcome of humanity's profit-seeking instinct, recur throughout financial history. Each bubble's formation and collapse is accompanied by similar cycles of human exuberance and rational collapse. The Dutch tulip bubble of the 1630s stands as the most quintessential example. Its emergence was no accident. At that time, the Dutch, leveraging their maritime supremacy, had become the global trade center, with Amsterdam emerging as Europe's financial hub. A substantial influx of capital into the Netherlands provided the financial foundation for the bubble's formation. Initially, tulips, prized for their rarity, became symbols of aristocratic status, their prices steadily rising and attracting some investors to trade. As speculative fervor spread, ordinary citizens also joined the frenzy, causing tulip bulb prices to skyrocket wildly beyond their intrinsic value. Historical records indicate that common bulbs sold for dozens of guilders, equivalent to several months' wages for an ordinary laborer. Rare governor bulbs were inflated to 20,000 guilders, representing a craftsman's decade's earnings and sufficient to purchase a mansion in Amsterdam's city center. Most Dutch participants in the speculation paid scant heed to tulips' intrinsic worth, their sole objective being to resell at inflated prices. This mindset prioritizing speculation over value represented the ultimate manifestation of humanity's profit-seeking instinct. The Amsterdam Stock Exchange even established a dedicated tulip bulb trading market, introducing forward contracts that allowed investors to profit from buying and selling agreements without physical delivery. Leveraged trading further amplified market volatility. In February 1637, when some investors cashed out their profits, market confidence collapsed. Tulip bulb prices plummeted by over 90%, bankrupting countless investors and dealing a severe blow to the Dutch economy. This event stands as a classic case study of a financial bubble in economic history. Remarkably, a similar scenario unfolded during Japan's bubble economy of the 1980s. Rapid economic growth coupled with yen appreciation attracted massive inflows of international capital into stock and property markets. Companies shifted away from manufacturing to financial speculation, while ordinary citizens engaged in frenzied property purchases, creating a nationwide speculative frenzy. Data indicates that property prices in Central Tokyo more than tripled between 1985 and 1990. At its peak, land in Tokyo's Ginza district exceeded $1 million per square meter, with media outlets exaggerating that Tokyo property prices could buy the entire United States. In the stock market, the Nikkei index soared from 12,000 points in 1985 to 38,915 points in 1989, representing a surge of over 220% within 5 years. However, this speculative-fueled prosperity proved short-lived. When the Japanese government tightened monetary policy in 1990, both the stock and property market bubbles burst. The Nikkei index plummeted, property prices fell persistently. Countless households faced hardship due to asset depreciation. Businesses collapsed en masse, and Japan's economy entered a two-decade stagnation period known as the lost decade. These historical examples demonstrate that wherever the lure of quick profits exists, human nature's tendencies towards herd mentality and greed are amplified, ultimately breeding bubbles. The consequences of these bubbles bursting are often borne by society as a whole. Finance, as an accelerator of civilizational progress, has consistently driven development. During the age of exploration, capital enabled adventurers like Columbus to chart new sea routes, catalyzing the formation of a global trading system. By pledging returns, Columbus secured a colossal investment of 2 million maravedis from the Spanish crown. These new routes not only shattered the spice trade monopoly but also triggered global capital flows, with vast quantities of gold and silver pouring from the Americas into Europe, providing ample funding for commercial expansion. Following Spain's discovery of the Potosi silver mines in the Americas in 1545, vast quantities of silver flooded into Europe. Statistics indicate that from the late 16th to early 17th centuries, over 200 tons of silver were transported annually from the Americas to Europe, a volume exceeding 5 times Europe's contemporary silver production. Whilst this influx of silver triggered a price revolution, driving up the cost of goods, it also propelled the rise of the merchant class, accelerated the disintegration of feudalism, and laid the foundations for the development of capitalism. The emergence of government bonds enabled nations to pool substantial capital for waging wars and constructing public infrastructure, thereby enhancing state governance capabilities. Following Britain's Glorious Revolution in 1688, Parliament enacted the Bill of Rights, explicitly prohibiting the monarch from arbitrarily defaulting on debt. This strengthened the credit foundation of government bonds, significantly boosting investor confidence in them. Historical records indicate that the scale of British government debt surged from £44 million in 1739 to £700 million by 1816, a 15-fold increase over 177 years. These funds underwrote Britain's victory in the Napoleonic Wars and the construction of its railway network, propelling the nation towards its status as the empire on which the sun never sets. The latest figures indicate that by early 2026, the UK's national debt had expanded to approximately £3 trillion, a substantial increase from £500 billion 2 decades prior. While this growth has introduced certain debt pressures, the UK government has maintained stability in the government bond market through robust debt management mechanisms and prudent maturity structure arrangements. Government bonds continue to play a vital role in supporting national public services and addressing economic crises, thus perpetuating the core logic of government bonds serving national development. The refinement of insurance systems reduced the risks of long-distance trade, underpinning the prosperity of international commerce. In 17th century Britain, as maritime trade expanded, seaborne hazards became a critical constraint on trade growth. The coffee houses of London's Lloyd's became gathering places for merchants, shipowners, and investors, gradually evolving into the specialized insurance institution known as Lloyd's. Lloyd's underwriter signature guarantee model. Multiple underwriters collectively assume the risk for a single merchant vessel, reducing the burden on individual investors and emboldening ships to venture across the oceans. Data indicates that by the early 18th century, Lloyd's underwriting accounted for over 60% of Britain's ocean-going merchant fleet, significantly boosting the nation's international trade. From ancient clay tablet lending to modern financial derivatives, financial forms have continually evolved. Yet their core function of propelling civilizational progress remains unchanged. In the modern era, these principles continue to manifest in emerging financial structures. Cryptocurrencies initially lacked regulatory constraints, becoming tools for speculation. Green finance channels capital towards environmental sectors through regulatory frameworks. Mobile payments reshape credit systems. These developments fundamentally perpetuate the core logic of credit, human nature, and civilizational advancement, further validating the enduring nature of financial historical patterns. The game-theoretic essence of cryptocurrency, under the banner of decentralization, Its early phase was a chaotic celebration where human profit-seeking outpaced regulatory frameworks, accompanied by fraud and asset theft. Subsequently, nations intervened through regulation to standardize markets, ultimately filtering valuable models while eliminating speculative instruments. At its inception, cryptocurrency's core selling point was decentralization, specifically, rejecting central bank oversight and national governmental intervention, with trust between transacting parties established through preset algorithmic protocols. This model, while seemingly novel, bears striking similarities to the unregulated credit transactions of early financial history. It resembles the oral lending practices among acquaintances in ancient Sumer, lacking a unified regulatory framework or authoritative credit endorsement, and relying entirely on mutual acceptance of the algorithm by both parties. The advent of Bitcoin in 2009 heralded the dawn of the cryptocurrency era. Initially circulating within niche technical circles, its price remained persistently below $1. As investor attention grew, its value began a gradual ascent. The cryptocurrency market experienced its first explosive surge in 2017, with Bitcoin's price soaring from $1,000 at the start of the year to $19,000 by year-end, a staggering increase of over 1,800%. This fueled the emergence of numerous altcoins, plunging the market into a chaotic frenzy. In this unregulated environment, the human instinct for profit-seeking was amplified. Countless ordinary investors, lacking financial investment experience, were lured by promises of high returns. Their focus narrowed to price fluctuations and short-term gains, mirroring the mentality behind the tulip mania of the 17th century. Data indicates that in 2017, global cryptocurrency investors exceeded 10 million, with over 70% having no prior investment experience. Concurrently, unscrupulous operators exploited regulatory loopholes to issue air coins, cryptocurrencies lacking any substantive business backing, relying solely on conceptual hype to raise funds before disappearing, leaving investors with nothing. In 2018 alone, over 1,000 cryptocurrency fraud cases were exposed globally, involving more than $10 billion. The Plus token case, for instance, involved 30 billion yuan and affected over 2 million victims. Furthermore, frequent technical vulnerabilities in exchanges and hacking incidents have become commonplace. The theft of 850,000 bitcoins from Mt. Gox, for example, highlighted the fragility of security measures. Gox in 2014 and the collapse of FTX in 2022 both resulted in substantial user losses. Due to the absence of regulatory frameworks and legal recourse, victims often find it difficult to seek redress. Some investors even mortgaged properties to borrow funds for cryptocurrency speculation, only to lose everything due to market volatility, triggering a series of social issues. This validates Toshihiko Sakaya's assertion that a credit system lacking regulatory constraints will ultimately be overwhelmed by greed, marking a chaotic period where human greed outpaces regulatory frameworks. Worse still, lured by high leverage, many investors mortgaged properties and borrowed funds to speculate in cryptocurrencies, only to lose everything overnight due to market turbulence, triggering a cascade of family and societal problems. Sakaya, Toshihiko's observation in A History of World Finance, that a credit system lacking regulatory constraints will inevitably be overwhelmed by humanity's innate greed, finds precise validation in the cryptocurrency sphere. This phase epitomizes a chaotic period where humanity's profit-seeking instincts outpace regulatory constraints. History often repeats itself in startling ways. Just as ancient Babylon established interest rate caps for lending through the Code of Hammurabi, and the Dutch government implemented policies to curb excessive futures trading and speculation, nations worldwide are now responding to the cryptocurrency chaos by stepping in with regulatory measures. These actions aim to standardize market order and prevent further risk propagation. The United States, possessing one of the world's most sophisticated financial regulatory frameworks, pioneered categorized oversight of cryptocurrencies. It explicitly classified certain crypto assets exhibiting securities characteristics as securities, mandating strict compliance with the Securities Act and related legislation. This requires entities to fulfill obligations including information disclosure and investor suitability management, thereby regulating issuance and trading activities at their source. In 2023, the U.S. Securities and Exchange Commission initiated legal proceedings against cryptocurrency exchanges Coinbase and Binance, alleging violations of securities regulations through failure to register relevant cryptocurrency products. This action drew significant global attention within the cryptocurrency market. China, however, adopted stricter regulatory measures from the perspective of preventing systemic financial risks and protecting investors' legitimate rights and interests. It explicitly prohibited token issuance, financing, and related trading activities involving virtual currencies, blocked channels for exchanging virtual currencies for fiat currencies, and curbed the spread of risks at their source. In 2021, the People's Bank of China and multiple departments jointly issued an announcement clarifying that virtual currencies are not legal tender and do not possess equivalent legal status to fiat currencies. It prohibited all virtual currency trading and speculation activities. Subsequently, regulatory authorities across the country launched special rectification campaigns, shutting down numerous virtual currency trading platforms and mining projects. The European Union has also introduced the world's first dedicated markets in crypto assets regulation (MiCA), legislatively defining compliance requirements for crypto asset entities across the entire life cycle from issuance to trading. Its formal implementation in 2023 marks the EU's entry into a phase of standardized regulation. These measures have filtered out cryptocurrency projects with genuine practical value while eliminating purely speculative air coins. This represents yet another iteration of the historical financial dynamic between disorderly innovation and regulatory standardization, demonstrating that only financial models grounded in credit foundations and regulatory frameworks can achieve long-term sustainability. For cryptocurrencies, those destined to survive and thrive will inevitably be projects capable of real-world implementation and addressing genuine societal needs. Examples include cryptocurrency applications leveraging efficiency advantages in cross-border payments and supply chain finance. Conversely, air coins relying solely on conceptual hype and lacking substantive value will gradually exit the stage under regulatory pressure and market selection. Indeed, some enterprises have already begun exploring practical cryptocurrency applications. For instance, multinational corporations utilize blockchain technology and cryptocurrencies for cross-border payments, reducing settlement times from the traditional 3 to 5 days to mere minutes while substantially lowering transaction costs. This process not only purifies the cryptocurrency sphere but also vividly demonstrates a core principle of financial history. Only financial models that align with societal development needs, possess reliable credit foundations, and operate within robust regulatory frameworks can endure and thrive. The balancing logic of green finance, leveraging a dual mechanism of policy incentives coupled with regulatory constraints, to channel capital towards environmental protection, new energy, and other sectors. This achieves resonance between capital's profit-seeking nature and the responsibility for sustainable development, yielding a win-win outcome for both economic and social benefits. The global prominence of carbon neutrality and carbon peaking stems from the escalating environmental challenges of industrialization, making sustainable development a shared human responsibility. Against this backdrop, green finance emerged, centered on directing capital towards green industries through financial mechanisms, balancing profit-seeking with environmental stewardship. Understanding the balancing logic of green finance hinges on clarifying the incentives for enterprises to proactively invest in environmental projects. Driven by profit objectives, sustained investment relies not solely on social responsibility. The crux lies in the dual mechanism of policy incentives coupled with regulatory constraints, transforming environmental investment into a stable profit-generating venture. Regarding policy incentives, nations implement preferential policies to reduce financing costs for green projects and enhance returns, establishing comprehensive support systems. Take China's green bond issuance as an example. These bonds carry explicit restrictions on fund usage, being dedicated to supporting renewable energy projects like wind and solar power, as well as the construction and operation of environmental protection initiatives, such as wastewater treatment and waste-to-energy incineration. To encourage corporate green bond issuance, the government provides issuers with interest subsidies, directly reducing financing costs. Concurrently, institutions investing in green bonds benefit from tax incentives such as corporate income tax and value-added tax reductions, enhancing their investment returns. Data indicates that by 2025, China's green bond issuance volume reached RMB 850 billion, representing a 120% increase from 2020, with approximately 70% of these green bonds benefiting from government interest subsidies or tax incentives. Beyond green bonds, financial products like green funds and green loans also receive comparable policy support. For instance, banks offering green loans implement lower interest rates, typically 1 to 2 percentage points below standard lending rates. The government provides risk compensation for green funds, mitigating investment risks. These policy measures effectively add a layer of reliable return assurance to environmental investments, enabling capital to clearly recognize that participating in environmental investments not only fulfills social responsibilities and establishes a positive corporate image, but also yields stable economic returns. This, in turn, guides capital towards actively flowing into the environmental sector. Data indicates that by 2025, China's green credit balance reached RMB 25 trillion, accounting for 15% of the total credit balance, an increase of 6 percentage points. Compared to 2020, significant capital inflows into green industries such as wind power, photovoltaics, and wastewater treatment have accelerated their development. Regarding regulatory frameworks, nations establish mandatory requirements to compel enterprises to increase environmental investments, fostering a market environment where failure to adopt environmental measures incurs disadvantages. The carbon trading market exemplifies this rule-driven model. The core logic of carbon trading markets is cap-on trade. By setting an upper limit on total carbon emissions, carbon emission rights are transformed into a scarce resource, compelling enterprises to reduce energy consumption and emissions. Taking China's national carbon market as an example, this market commenced trading in 2021 and stands as the world's largest. By the end of 2025, it had incorporated 3,378 key emitting entities spanning high energy consuming sectors including power generation, steel, cement, and aluminum smelting. These enterprises account for over 40% of China's total carbon emissions. Throughout 2025, China's national carbon market operated across 243 trading days, with quota trading volumes reaching 235 million tons, a year-on-year increase of approximately 24%. The total transaction value amounted to RMB 14.63 billion, with trading prices maintained within a reasonable range. The year-end closing price stood at RMB 74.63 per ton, while the annual average trading price was RMB 62.36 per ton. The specific rules are as follows. The government sets clear carbon emission quotas for enterprises based on regional environmental carrying capacity and the dual carbon goals. Enterprises must ensure their actual carbon emissions remain within these quotas. Enterprises with good energy saving and emission reduction performance, whose emissions are below their quotas, can sell their surplus allowances on the market for profit. Enterprises exceeding their quotas must purchase allowances. Otherwise, they face severe penalties such as heavy fines and restrictions on production scale. In 2025, over 500 Chinese enterprises were fined a collective sum exceeding 1 billion RMB for failing to purchase quotas after exceeding their carbon emission limits. Some also faced production scale restrictions. This measure effectively compelled enterprises to proactively increase investment in energy conservation and emission reduction. Beyond carbon trading markets, several nations have introduced mandatory green disclosure regimes. These require companies to regularly publish environmental, social, and governance ESG information, enabling investors to clearly assess corporate environmental performance and directing capital towards enterprises with strong environmental credentials. The European Union formally implemented the Sustainable Finance Disclosure Regulation in 2024, mandating large enterprises and financial institutions operating within the EU to regularly disclose the environmental impacts of their business activities and the environmental risks they face. Companies failing to comply face substantial fines. Toshihiko Sakaya noted in the History of World Finance that finance is the accelerator of civilization, a perspective embodied by green finance. Prior to the development of green finance, capital tended to cluster in sectors offering quick returns, such as real estate, while areas with long-term value, like environmental protection, suffered from a shortage of funding. In 2015, financing for China's environmental protection industry accounted for only 2% of total financing, while real estate claimed over 30%. Guided by green finance regulations, capital has now flowed into environmental protection and new energy sectors, optimizing resource allocation and propelling civilization towards green and sustainable development. For instance, the large-scale implementation of renewable energy projects like wind and solar power has reduced humanity's dependence on fossil fuels and lowered carbon emissions. Data indicates that by 2025, wind and solar power generation in China accounted for 25% of the nation's total electricity output, an 18 percentage point increase from 2015. Equivalent to reducing carbon dioxide emissions by 230 million tons. The construction of sewage treatment and waste-to-energy incineration projects has improved the ecological environment and enhanced residents' quality of life. By 2025, China's urban sewage treatment rate reached 98%, a 10 percentage point increase from 2015. Waste-to-energy incineration accounted for 65% of total waste disposal, a 30 percentage point rise from 2015, effectively resolving the issue of waste encroaching upon cities. This development model simultaneously satisfies capital's profit-seeking instincts while fulfilling the responsibility for sustainable civilization, achieving a win-win outcome for both economic and social benefits. It stands as a novel exemplar in financial history of rules guiding human nature. The value of mobile payment in credit reconstruction. At its core lies the restructuring of the credit system for the new era. Through electronic clay tablet, style transaction records and dual safeguards from both government and platforms, it reduces transaction costs and risks. Simultaneously, it breaks down traditional credit barriers, enabling credit-deprived groups to access financial services. Prior to the widespread adoption of mobile payments, cash transactions faced risks of counterfeit currency and loss. Globally, counterfeit currency losses exceed $20 billion annually, while China sees over 100,000 cases of cash theft or loss each year. Credit card payments carry fraud risks and limited usage scenarios, with over 20,000 credit card fraud cases reported in China during 2020. These challenges stem fundamentally from an imperfect credit system driving excessive transaction costs, mirroring the Sumerians' lack of documented evidence for verbal loans. Both issues arise from the absence of effective credit carriers and safeguards. Credit card payments carry the risk of unauthorized transactions. Data indicates that in 2020, China witnessed over 20,000 cases of credit card fraud involving more than 1 billion yuan. Furthermore, due to issues such as transaction fees and settlement processes, some small merchants do not accept credit card payments, limiting the payment scenarios. These payment environment challenges bear striking resemblance to the Sumerians' pre-tablet era, when lending relied entirely on verbal agreements without written proof. Disputes over debts became contentious and difficult to resolve, fundamentally stemming from the absence of credible credit mechanisms. The proliferation of mobile payments fundamentally reconstructs the credit system. By employing technological means to create an electronic clay tablet style credit carrier, it renders interpersonal trust simpler and more reliable, thereby completely transforming the pain points of traditional payment models. The widespread adoption of mobile payments has restructured the credit system, utilizing technology to establish an electronic clay tablet style credit carrier that makes trust simpler and more dependable. Each mobile payment transaction generates an electronic record containing critical details such as transaction time and amount. Utilizing technologies like blockchain ensures these records are tamper-proof, enabling swift retrieval and verification in the event of subsequent disputes. Data indicates that by 2025, the average resolution time for mobile payment disputes in China will be just 2 hours, over 90% faster than traditional cash transactions. These electronic records provide a tangible foundation for credit, reducing information asymmetry between transacting parties. Data indicates that by 2025, the average resolution time for mobile payment disputes in China will be just 2 hours, over 90% faster than traditional cash transaction disputes. These digital clay tablet style transaction records, much like the Sumerians' inscribed clay tablets documenting loans, provide a tangible medium for credit. They reduce information asymmetry between trading parties, establishing clear foundations for trust. Beyond these digital transaction records, mobile payments establish a dual safeguard mechanism combining government oversight and platform guarantees, further fortifying the reliability of the credit system and enabling users to utilize mobile payments with confidence. Relevant government departments rigorously supervise payment platforms' fund security and operational compliance, mandating adherence to regulations governing reserve fund management, anti-money laundering, and anti-fraud measures to safeguard user funds. The People's Bank of China mandates that customer reserve funds must be fully deposited into designated special accounts at commercial banks, subject to banking oversight. Payment platforms are prohibited from misappropriating these funds, fundamentally safeguarding user capital. By the end of 2025, China's payment platforms held customer reserve funds totaling RMB 2.8 trillion, all stored and regulated through dedicated accounts. Payment platforms themselves invest substantial resources in establishing risk prevention systems. These include employing big data analytics to identify anomalous transactions, and utilizing biometric technology to enhance account security, thereby safeguarding users' funds and information at a technical level. Data indicates that by 2025, the fraud rate for mobile payments in China stood at a mere 0.01%, significantly lower than that of traditional payment methods. This dual safeguard mechanism of government oversight coupled with platform guarantees enables users to utilize mobile payments with confidence. Reliable credit safeguards not only reduce transaction risks but also substantially boost efficiency. The cumbersome processes of traditional cash transactions have been replaced by QR code payments, shortening transaction times from minutes to seconds and dramatically lowering transaction costs. By 2025, the average mobile payment transaction in China took just 3 seconds, saving society over 100 billion RMB in time costs through enhanced payment efficiency. The value of mobile payments in reshaping credit systems is further evident in breaking traditional credit barriers, enabling rural hawkers, individual traders, and other credit-deprived groups to access financial services. The conventional financial system relies on formal business licenses and bank statements as credit proof, excluding vast numbers. In 2015, credit availability in China's rural areas stood at merely 30%, with countless small traders unable to secure loans due to insufficient documentation. The proliferation of mobile payments has transformed this landscape. When these vendors receive payments via mobile platforms, the systems automatically log their transaction histories, business operations, and payment frequencies. This data forms a comprehensive digital credit profile, serving as a crucial basis for assessing their creditworthiness. Armed with this digital credit record, they can now apply for small business loans from internet-based financial institutions like MY Bank, resolving their cash flow challenges. For instance, in rural areas, many small shopkeepers receive payments via WeChat Pay or Alipay. Platforms assess their monthly receipts, transaction volumes, and other metrics to determine appropriate loan limits. Shopkeepers can apply for loans at any time, with funds arriving within minutes and without requiring any paper documentation. Data indicates that by 2025, institutions like MY Bank will have disbursed small loans totaling 1.2 trillion yuan based on mobile payment transaction data, serving over 30 million rural vendors and individual businesses. This has elevated their credit accessibility to over 85%. The digital credit profile significantly lowers the threshold for accessing credit systems, enabling greater participation in financial activities. This mirrors the logic of the Dutch East India Company, which reduced investment barriers through limited liability. Both approaches expand financial service coverage through innovation, the core of financial decision-making for ordinary individuals. When encountering new financial products or investment opportunities, two fundamental questions must be addressed: whether a reliable credit foundation exists and whether the regulatory framework is robust. With new financial products proliferating, ordinary investors are easily lured by high returns and novel concepts into pitfalls. In 2025, China saw over 500,000 financial consumer complaints, 60% stemming from ill-informed investments in novel financial products. Historical patterns in finance reveal that rational decision-making hinges on grasping credit and rules. Clarifying these two core issues prevents being swept up by speculative fervor. The first question to clarify is, does this financial product possess a reliable credit foundation? Credit forms the bedrock of finance. Any product detached from credible credit support is fundamentally a speculative instrument whose risks are uncontrollable. A reliable credit foundation manifests in two key aspects. Firstly, whether it carries authoritative credit endorsement, such as government backing or guarantees from major financial institutions. Secondly, whether it possesses genuine application scenarios and a viable profit model capable of generating sustainable cash flow. Take government bonds as an example. Their status as low-risk investments stems fundamentally from their robust credit foundation. Issued by the state, they are backed by national tax revenues as the repayment source and explicitly guaranteed by parliament or the government. This sovereign credit represents one of the most reliable forms of endorsement. Data indicates that the global default rate for government bonds has long remained below 0.1%, making them among the financial products with the lowest default rates. Similarly, bank deposits are safeguarded by deposit insurance schemes. In China, deposits up to 500,000 yuan are fully covered. By the end of 2025, the deposit insurance fund had reached 150 billion yuan, with over 100 payouts made, effectively protecting depositors' interests. Conversely, Certain products like air coins and virtual real estate lack authoritative backing and genuine application scenarios. Their value relies on speculation, resulting in a weak credit foundation. During the 2022 virtual real estate speculation boom, prices on some metaverse platforms soared to $100,000 per square meter. Subsequently, with no underlying demand, prices plummeted by over 90%, leaving numerous investors trapped. When assessing creditworthiness, one must guard against the high-yield trap. Financial history repeatedly demonstrates that high returns come with high risks. Products claiming high returns with zero risk almost certainly have a false credit foundation. For instance, during the P2P lending chaos, numerous platforms lured investors with annualized returns exceeding 20% and guaranteed principal and interest, yet these were essentially Ponzi schemes lacking genuine project backing. Between 2018 and 2020, China shut down over 5,000 P2P platforms, affecting more than 10 million investors and involving over 1 trillion won. Investors need only scrutinize whether there is authoritative endorsement and a genuine profit model to expose such schemes. For these products, a moment's reflection on their credit foundation, lacking authoritative backing and a viable profit model, reveals the deception. Moreover, genuine application scenarios form a crucial pillar of creditworthiness. For instance, green bonds are underpinned by explicit environmental projects as their capital allocation, generating stable returns. These tangible cash flow provides a reliable credit foundation. Conversely, financial products with ambiguous capital usage or unclear investment directions often exhibit questionable creditworthiness. When selecting financial products, investors should proactively investigate details such as capital allocation and profit models, avoiding those that peddle narratives without delivering tangible results. The second critical question to clarify is the regulatory framework underpinning the financial product robust? A sound regulatory system encompasses clear oversight mechanisms, robust risk prevention and control measures, and transparent dispute resolution channels. Take the stock market as an example. Securities regulators establish rules governing listed companies' disclosure practices. Listed firms maintain comprehensive governance and risk management systems, and investors whose rights are infringed have multiple avenues for redress. In 2025, the China Securities Regulatory Commission investigated over 300 illegal cases, imposing penalties exceeding 5 billion yuan, thereby effectively maintaining market order. Conversely, areas with inadequate rules and regulatory gaps are high-risk zones. During the early development of cryptocurrencies, for instance, the absence of clear regulation led to frequent fraud and coin theft incidents. In 2022, global investors suffered losses exceeding $20 billion, with over 80% unrecoverable. Certain emerging internet-based financial products initially faced regulatory lag, making them susceptible to risks such as misappropriation of funds and platform operators absconding. Therefore, ordinary investors should ascertain the regulatory authority overseeing a product, its governing rules and risk control measures, avoiding products operating in regulatory vacuums. Similarly, some emerging internet-based financial products may encounter regulatory lag during their initial development phase, characterized by incomplete regulatory frameworks and inadequate risk prevention mechanisms, thereby increasing the likelihood of risks such as misappropriation of funds and platform operators absconding. Consequently, when encountering novel financial products, ordinary investors must ascertain the relevant regulatory authority, specific regulatory frameworks, and the adequacy of risk mitigation measures. Should a financial product operate in a regulatory gray area without clear rules, investors should avoid it to prevent exposure to risk. Investors may consult regulatory authority websites or seek professional financial advice to understand a product's regulatory status and make rational investment decisions. The ultimate purpose of finance and principles for ordinary individuals. Finance's core value lies in fostering greater stability in daily life and societal progress. Ordinary people need not chase incomprehensible quick profits. By upholding fundamental integrity, understanding regulatory logic, and making rational decisions within their risk tolerance, finance can effectively serve their lives. Toshihiko Sakaya concludes in A History of World Finance. The ultimate purpose of finance is to make everyone's life more stable and society more progressive. This perspective profoundly reveals finance's core value. It is not a tool for speculation and arbitrage by the few, but a vital force serving ordinary people's lives and driving societal development. Zuyod Financial History. Every innovation emerged with the original intent of meeting genuine human needs and solving practical problems. The Sumerians' clay tablet lending addressed capital turnover issues in agricultural production. The emergence of government bonds met the funding needs for national construction and warfare. The establishment of insurance systems countered the risks of maritime trade, and the proliferation of mobile payments enhanced transaction efficiency while reducing costs. These financial innovations ultimately served people's lives, making existence more stable and convenient while propelling societal progress. Yet some have perverted finance into a tool for quick profits through speculation, betraying its fundamental purpose and triggering market chaos and risk accumulation. The tulip mania, Japan's asset bubble, and the 2008 financial crisis all stemmed from excessive financial speculation, resulting in massive investor losses and socioeconomic turmoil. The 2008 financial crisis originated from the U.S. subprime mortgage crisis, where financial institutions packaged subprime mortgages into derivative products. Lack of risk control led to the collapse of the financial system, harming countless families. Ordinary individuals must cultivate sound financial principles, recognize the fundamental purpose of finance, and avoid blindly chasing quick profits. The primary principle for ordinary people in financial matters is to uphold the baseline of creditworthiness. A sound credit history is fundamental to accessing financial services. When applying for loans, a positive credit record secures lower interest rates and higher borrowing limits. Timely repayments on mobile payments and credit cards maintain one's credit standing. Data indicates China's credit reporting system covers over 1 billion individuals, with more than 80% possessing favorable credit records, thereby enjoying greater financial accessibility. When selecting financial products, one must also adhere to principles, prioritizing offerings from reputable institutions like banks with reliable credit foundations. Secondly, ordinary individuals must comprehend the underlying logic of financial rules. These rules ensure the orderly functioning of financial markets and are crucial for risk prevention. Different financial products operate under distinct regulatory frameworks. Before participation, one must understand the profit model, risk points, and regulatory requirements to avoid disputes arising from ignorance of the rules. In 2025, over 40% of complaints from Chinese insurance consumers stemmed from misunderstanding policy terms, particularly exclusion clauses. Grasping these rules enables rational assessment of risk-return profiles and prevents misguidance by false advertising. Finally, individuals must make rational decisions within their risk tolerance. Each person's capacity to bear risk varies, depending on factors such as income level, asset status, and family circumstances. Investors should select suitable financial products based on their actual situation, avoiding blind pursuit of high returns at the expense of risk. For instance, young individuals with stable incomes and favorable asset positions possess relatively higher risk tolerance. They may appropriately allocate funds to higher-risk financial products like equities and mutual funds to pursue greater returns. Conversely, elderly individuals nearing retirement with single income streams exhibit lower risk tolerance. They should prioritize low-risk, stable financial products such as government bonds, fixed deposits, and money market funds to safeguard asset security. Data indicates that by 2025, over 70% of China's elderly population will allocate their financial assets to low-risk products, while the proportion of higher-risk products among younger groups will exceed 40%. This allocation pattern aligns with the differing risk tolerances of each demographic. Concurrently, leveraging capital for investment should be avoided as it amplifies risk. By 2025, over 30% of Chinese investors suffering losses from leveraged investments faced asset freezes and debt burdens. Rational decision-making also entails resisting herd mentality, a significant cause of losses in financial markets. In 2025, over 60% of cryptocurrency investors follow trends, with 70% incurring losses. Ordinary individuals should resist herd mentality, conduct rational analysis based on personal circumstances, and seek professional advice or financial education when necessary. Ultimately, finance's purpose is to serve daily life and drive societal progress. By upholding fundamental principles of creditworthiness, understanding underlying rules and logic, and making rational decisions within one's risk tolerance, individuals can harness finance to steadily accumulate wealth. From Sumerian clay tablet lending to mobile payments, financial forms evolve while the core principles of credit and rules remain constant. Grasping these principles enables composure in financial affairs, an enduring lesson from the laws of financial history.